When you say paying the banks, what they really mean is paying the bank bondholders. They are basically the 1%. Michael Hudson. Welcome back to the channel. This is where truth meets transparency. Today we're pulling back the curtain on the Bank for International Settlements, ushering the narrative that the BIS is silencing innovation, which is quietly steering us away from crypto and blockchain's retail promise. They present themselves as guardians of financial stability, but are they just preserving old power? Politicians debate endlessly. Presidents make promises, but none of them hold the real power. Behind the curtain sits the Bank for International Settlements, the central bank of central banks, quietly directing global monetary policy. If you think your president, chancellor, prime minister, governor, and monarchs run the global financial sector, you're sadly mistaken. The BIS makes the rules for the world's global banking sector, and they tell your local leader what forms or function to implement for financial stability. Each country is indebted to the BIS, and if they don't adhere to the BIS standards, they are punished through the unstabilizing of the local economy. Today we'll expose how the BIS downplays crypto and blockchain, not because it's useless, but because it threatens their grip on the financial system. Let's break it down.
Of a vision of the future monetary system, a unified programmable ledger. Give us a sense of why and what the vision hopes to achieve eventually.
What we want is to lay the ground, the infrastructure for a modern financial system. Now, the technology is moving very fast. We have a very solid foundation. So the idea is basically to use that solid foundation, incorporate the new technologies, and facilitate the development of a future financial system.
What gaps in particular are you trying to fill?
Well, one, of course, is that financial system, as efficient as it is today, is still full of transaction costs, compliance costs too. So one very important motivation is to reduce those frictions as much as possible. The other thing is to onboard more people more easy. For example, one of the main issues related to lack of sufficient inclusion is that precisely transaction costs are very, very high. Therefore, to manage small payments or to give access to small firms, so small, medium-sized enterprises or services to people in remote areas is still a major problem.
That sounds reasonable, right? But look deeper. They're not critiquing blockchain's capability. They're planning out, suggesting that unless money comes from them, it can never be trusted.
One of the priorities for the BIS in 2023 is to focus on stablecoins and CBDCs as well. I'm just wondering, in terms of regulation, what additional regulation do you foresee that's needed?
Well, in terms of, yes, cryptocurrencies need to be regulated. It is obvious now that it is necessary. Certainly aspects of consumer investment protection is very important. And well, of course, also focusing on the exchanges. The exchanges are key. How some of these activities interact with the traditional financial system. Some should be valid, some should be tolerated, and those are the ones we should regulate.
Translation. Trust doesn't come from transparency, code, or math. It comes from central banks. In other words, only the BIS and its member banks can define what money is. They warned that stablecoins lack anchors. Stablecoins, of course, are one of the easiest ways for ordinary people to access digital assets. But instead of innovation, the BIS paints them as a danger.
What do you think is impacting the views of central bankers the most right now when it comes to the crypto ecosystem? I mean, how much of it has to do with the FTX incident, for instance?
Well, you know, a few years ago, crypto assets and cryptocurrencies were in a way put as an alternative to fiat money. I think that battle has been won. Technology doesn't make for trusted money. The most important aspect is for these activities not to have a systemic impact. I mean, at the end of the day, if this grows dramatically and we have events like FTX, that at some point could have a systemic systemic impact. And that's something that we want certainly to prevent.
He claims crypto has failed to live up to its promise. Has it failed, or has it succeeded so much that now it threatens their dominance?
I don't see any dominance of cyber currencies. They're new, they're innovative, they're serving a purpose more than anything, particular cyber currencies as a speculative vehicle. It helps, you could claim that it helps diversification and so on, but they really do not have made any inroads in terms of working as money. Stable coins also have some limited applications, and they have their own role for very specific purposes. Therefore, I don't see any challenge, I would say, to sovereign money coming from these privately used currencies.
The BIS begins by stressing the risk of crypto, not its potential, not its breakthroughs, just its dangers. This is classic framing. Lead with fear to shape perception.
Do you think there needs to be more regulation in the private cryptocurrency space, though?
Yeah, because to a large extent they're used to do some arbitrage or to circumvent some regulations. I mean, AML-CFT, for example, is completely, well, it's quite absent in many applications of some cyber currencies. There are aspects also of reliability of the systems. In terms of investor protection, I think that we need to move forward. Also, some stable coins, if they were going to be applied massively, the issue of what is backing those currencies is of the essence. And we have many episodes in the history of finance where something that is supposed to be completely backed, at the end, it doesn't end up being fully backed. Therefore, I think, yes, we need to work on regulation so that these instruments are fit for purpose.
Listen carefully. That's not an analysis. It's a warning. They're not saying blockchain doesn't work. They're saying it won't be allowed to work unless it's under their control. Crypto, they say, fuels money laundering, crime, and ransomware. But here's the irony. Cash, dollars, and euros are used for far more crime worldwide. Yet because these are central bank currencies, the BIS never raises the same alarm.
I do think the report was a little bit misguided, and I think a lot of what we have to remember here is that crypto is so early in its development. Bitcoin hasn't even celebrated its 10th anniversary yet, its 10th birthday yet, and there's a lot that has to be built. If we think back to the internet as it was getting started, there were scalability issues, there were speed issues, there were quality issues, and those had to be solved with new technologies and new products as the ecosystem developed. That exact same thing is happening in crypto, and we're seeing a lot of very exciting products around scaling, exciting solutions around some of the environmental concerns, all being developed right now as these things start to reach scale and start to run into the problems that BIS correctly identified do exist. And a big part of us, what we're seeing at CoinList is, we look at these projects and help the best digital asset companies manage their token sales. We're looking at these infrastructure projects and seeing a lot more great teams from academia and from industry working on solving the scalability issues.
The BIS proudly explains its role in international coordination, but coordination is a polite word. In truth, they dictate. Through agreements like Basel I, II, and III, they decide how every bank on earth must operate.
In terms of users, because that was one of the main points of the BIS report as well, that without users, Bitcoin or any other cryptocurrency is simply a worthless token. I mean, you use a parallel of the internet back in the 90s. Back in the 90s, people were signing up for AOL accounts, they're exchanging emails, et cetera. There's sort of a flywheel effect because as they were doing this, there was an ecosystem being built around that for e-commerce and goods being exchanged, et cetera. It doesn't feel like the same sort of build out right now in cryptocurrency in terms of use case and all the different applications being built around it that we feel in our daily lives.
Yeah, we think those products are just being built out right now. So we see Bitcoin primarily as a store of value, almost like a digital gold. And that use case is happening. People are buying and holding it and using it as a way to store value. A lot of the new products that will have more specific consumer use cases held initial coin offerings or token sales in the year 2017, which was really when that boom of cryptocurrencies happened. And we're now just a year out from that. They're just starting to ship product. We're excited about products like Augur, which is a prediction market, launching in July, and a number of others that are coming out over the course of the next 6 or 9 months. And that's when I think we'll see these commercial applications start to emerge. Right now, we're mainly focused on developing the store of value applications and getting those other flywheels started. To your point, these applications need to exist. We need users for these products, and that's going to happen this year.
The BIS assure us that they're building the frameworks to protect financial stability. But ask yourself, stability from whom? For citizens or for the very system that keeps them in power?
So Andy, and you talk about a store of value, and it's being used right now as a store of value. Can you also say in the same breath that that very same coin is also a means of transaction? If it's being marketed right now as a store of value, does that then just flip overnight?
We think that Bitcoin isn't really meant to be a means of exchange, a medium of exchange for transacting value, but rather just as a store of value, and that other cryptocurrencies will be used as a medium of exchange. We're excited about this trend of stablecoins, which is tokens that are pegged to a specific value, perhaps consumer price index or even the US dollar as a medium of exchange. You need stability if you're going to use something as a medium over the course of weeks or months. And so looking at stablecoins as a solution to that is interesting. Looking at case-specific tokens, things like Filecoin or Blockstack that support their own networks is really interesting. And then looking at separately things like Bitcoin as a store of value, we see those as 3 very different categories, and not necessary that each of them fits into all 3.
The BIS discusses digital currencies. Notice their language. They don't reject blockchain. They're experimenting with it, but only for central bank digital currencies, the CBDCs. They're not against the tech. They're against you using it to get outside of their control.
So in 5 years, or maybe even less, Andy, do you foresee that somebody like me or you would have a portfolio or a wallet filled with different coins for which each has a different use? That seems like a lot of effort. I mean, you want to be able to solve a problem and not create more problems for people to be able to track these coins, rely on the stability of these coins, and also use these coins in very specific use cases.
We totally agree. And that's where I think the stablecoin point comes in, that can be used as a medium of exchange for a lot of different applications. Separately, we look at these tokens that are meant for specific networks. Those won't be used by every single person, and perhaps we'll actually be using applications built on top of those protocols. So if you look at something like a Filecoin, that's an incentive system for allowing for transactions on top of a file storage network. I might use an application that doesn't actually expose Filecoin to me as the end user at the end of the day, in the same way that I might use Dropbox as an application without realizing that I'm actually interfacing with something like Amazon S3 or their own data centers. Another example of that is something like Origin Protocol, which is a sale that we're recommending to our investment clients right now on CoinList. And that's a product that will allow for sharing economy marketplaces like a decentralized Uber or decentralized Airbnb to be built. It won't be that the end users necessarily have to interact with that token, but rather they can use these applications built on top of it that will use the token to enable the economy underneath.
That's where the rubber meets the road. They admit the truth. They admit that this is the future. This is the future monetary system. The future lies in integrating new technology into the current regulated system.
That the corona crisis has even revealed more the need to have a digital central bank currency or currencies.
Well, yes, I think the corona crisis has accelerated very much technical change and use of digital innovations across the board. I mean, it's not only in financial transactions, but in e-commerce and show business. I mean, there are so many examples that you know. But yes, it is a factor.
Do you notice how he frames the message? Digital currency isn't a threat, it's a tool, but only if wielded by them. He's not talking about decentralized innovation. He's offering a controlled gateway to new technology, one that ensures central banks continue pulling the strings.
When we talk about central bank digital currencies, would it not make sense just to have one worldwide? I know it's a bit of a weird question, but what do you think?
No, I mean, I think that each central bank, each country should have its own sovereign currency. What is important, and I think a lot of the work that we are doing is, given that pretty much all central banks are thinking about this, it's a unique opportunity
for the different central banks' digital currencies to be interoperable, that their systems are congruent between each other, and therefore that transactions in different currencies can be done in a seamless way. As a matter of fact, today we published a report, the CPMI YOSCO report on CBDC and international payments. And there the idea is precisely what is the design features that CBDCs should have so that you can make 24/7 instant payments between countries with very low commissions. I mean, today, a payment from, let's say, Mexico to the US can take days, and sometimes the commissions you pay is 7%. That's ridiculous. So what I think we need to do is to take advantage of the fact that pretty much everybody is starting from a clean slate, so that we can incorporate from the origin the interconnectedness between the different systems.
And here it is, the trust barrier again. Not about transparency, not about empowerment, but about them being the only ones who can guarantee it. In other words, blockchain is fine as long as they monopolize it. The BIS's passive approach isn't just hesitation, it's strategy. By wrapping retail adoption in fear, uncertainty, and doubt, they buy themselves more time to finalize the rails of a new financial system. They know that if the average person realizes the cost of living isn't getting cheaper, if people begin to question why their money buys less each year, they'll start searching for alternatives, risk assets, digital stores of value, and decentralized systems. That's why the narrative matters. As long as retail remains encapsulated in doubt, the pressure stays off the system. But the truth is simple. The longer they delay, the more the cracks in the old model shows. And once the public starts connecting those dots, no amount of FUD will be enough to hold back the shift. The question isn't if this transformation happens, it's when. And whether we let central banks control the rails or whether people choose to step outside the system and build their own. Please comment, like, and subscribe. Peace.